Hi, good morning, everyone. Before we start today's session on Raise Fund Like a King, Investment Resource Planning and Best Practices by Vandana Tolani, I would just like to take you all through Founders Genie. Founders Genie is based on the mastermind concept, which was formally introduced by Napoleon Hill in his book Law of Success, defining as the sum total of the minds of two or more people who work in perfect harmony for attainment of a definite purpose. A mastermind peer-to-peer mentoring group is used to help members solve their problems with input and advice from like-minded founders. Founders Genie is a well-constructed peer group which serves as an anchor for learning. Will provide entrepreneurs to make their journey less lonely. The mastermind concept can help you accomplish in 1 year more than you could accomplish without it in a lifetime if you depended entirely on your own efforts for your success. While we have read about it, we have had the good fortune of experiencing it through our platform. Founders Genie is built on 3 pillars of high quality, quick solution, and cost effectiveness. Its primary objective is to find solutions to any given real life problem. You can hire pre-referred talent, look for mentors, explore synergies, find industry specialists, experts, and yet be free of spam messages. We are happy to announce that Founders Genie provide you access to solutions at your fingertips via our app. To join our app, request you to scan the QR code at the bottom left of the screen, which will take you to our website. You can fill in the form and we will get back to you. We are happy to provide you a limited time of complimentary period for our application. Also, if you're an experienced industry veteran who is looking to help and guide startup, you can register as a mentor on Founders Genie app, and we will get back to you if there is a. All right, with that, I would like to introduce our speaker of the day, Vandana Tolani, who's CEO and founder at Convanto. Vandana is a versatile and dynamic professional with over 20 years of experience in the investment banking and venture capital arena, and founded Convanto, a boutique investment banking firm focused on fundraising and consulting early age startups. Before founding Convanto, she had a family office fund in Singapore and Jakarta. A diversified set of experiences has enabled Vandana to develop an eagle's eye for spotting opportunities in industries that are set for long-term growth in Indian economic context. She is also passionate about helping business reach the right people and fulfill their business requirements. She worked as an investment banker and advisor to family offices and angel investors in Jakarta, Indonesia, helping startups in fintech, B2B tech, all the way to consumer startups raise funds and providing them with a range of services such as fundraising, marketing, and growth advisory. And currently, she is an advisor to Loyal VC and connected with 300 plus investors globally. She has been awarded as one of the top 10 women leaders in wealth management. In Jan 2022, she was awarded as top 10 futuristic woman along with Nika. Her brand Convanto was also awarded by Kiran Bedi at Tech Startup Conclave 2022 for Best Financial Institution for supporting startups. Welcome, Vandana, for today's session. With this, over to you.
Okay, so first of all, I want to thank all of you. I see 105 participants here for joining this session and allowing me to give this session in Founders Genie. Without further delay, I would just start with my presentation, if that's okay.
Yes, sure.
Just sharing my screen. 1 second. Are you able to see my screen, all of you?
Yes. Yes, it's visible now.
Okay. So today's topic is raise funds like a king. Essentially, it's all about investment resource planning and best practices. since we've already spoken a lot about my profile, I will skip this. Skip about my company as well. Now let's see what sessions we are going to do. We are going to touch here decoding the investor's mind, investment resource planning, best practices for fundraise, and key resources for fundraise. How to raise multiple rounds of fundraise as well. First comes the phases of investments, which is essentially what comes at concept stage, what comes at optimized stage, what comes at building stage, and scale. Many of us are unaware, when we need angel funding, which is at concept stage, when we need growth capital, what is pre-series A and series B. Let's start with 3 big mistakes made by early stage entrepreneurs. Now, mistake number 1 is building something nobody wants to buy because they didn't talk enough to their customers. If you're making a hovercraft but customers want a little red wagon, you're wasting your time and money. So the tip here is keep the design simple, like Steve Jobs is the god of design. UI UX attractive, and listen to your customers first, because essentially they are the ones that are going to bring you the business. Mistake 2 is creating a homogeneous team, which is the right team. The right team is critical, and you need to diversify culture, age, and thought. So when I say a right team means a complementary team, complementing each other, which means a marketing team, technology team, a CFO on board, an advisor on board. These are some of the musts that early stage entrepreneurs must have on their platform. And everybody must wear multiple hats in order to have design and creative thinking. Mistake 3 is misunderstanding the market opportunity and competitors. Just because there is no direct competitor, that doesn't mean someone with more money can adjust and beat you. So I think it's very, very important to know what's there out in the periphery. Being much ahead of the time means you will be selling a lot of rupees on developing the markets and educating people. So don't do that ever. So what's the tip here is make sure you do a lot of market survey and brainstorm with the right industry experts in order to get the business model right. Because once you start the organization, there is no looking back, and it can burn lakhs of rupees and waste a lot of precious and valuable time. Now let's see fundraise best practices to be allowed, and religiously what I mean is that fundraising is built on relationships, so we need to start early. Now many of us feel that our financial capital is our actual capital, but to me I feel that our human capital is our actual capital. Your network, your relationships that you build with the fund, with other entrepreneurs, your relationships that you build with your alumni, your team, you need to be a people person and be able to build relationships, because essentially that is one of the key things that gets you funded. Now plan to contact at least 100 investors. It's very, very important, but no cold calling. So I feel that it is important to hire the right kind of CFOs, advisors, investment bankers on your team who have the right kind of relationship with these investors to help you get the funds. Yes, it is essential at least to have 100 good investor connects, so that you know what is it that you're lacking or what is it that you need to do more with your team. Now let your work talk for yourself, and your customers are your brand ambassadors. Why do I say this? Is sometimes you need to let the work that you are doing in the market speak for you. Let your customers, so many of the startups that come to me, most of them are referrals from some past clients, some investor, some of my entrepreneur friends, because the work speaks for itself. So I'm giving Convanto as an example because I don't know what all work you guys do. Then comes the venture capital community is small, so let's not burn bridges. Now, what do I mean by burning bridges? I have seen founders having bad tips with investors, with entrepreneurs, with behavioral issues. So I think we need to maintain a cordial relationships with everybody rather than burn bridges with people around us, especially the venture capital community, because people, the financial community within the venture capital is a small community, and people do talk about each other, and they do help you, pass the word around. Now, build passion and attitude into your pitch every day, and CEOs are the powerhouse for their employees. When I say this, many CEOs, CFOs, founders of the company, they forget to notice these small things, that a pitch deck, a business plan, a financial model and valuation has to be made by a professional. It has to be built in a global market standards, and I think it is okay to invest in it because this is going to stay with you in the long run. So hence, build passion and attitude into your pitch deck, every day. Follow up 3 times with VCs. So if you are directly in touch with VCs, please do not do it over a 2-day span, but 2 or 3 week follow-up period, because follow-up quickly and consistently kills the deal. In case you are directly in touch of a VC, immediately after the call, don't start pinging them and asking them for feedbacks, etc. Give them some time. The investment committee essentially decides whether the deal will get funded or no. So even if you have reached to the MDs of the fund, they will also take the deal to their team, then it will go to the investment committee. So everybody has processes, hence they need a bit of time to get back to you. Also, I feel you need to pre-qualify your investors to maximize everyone's time. Quickly establish the investors' investment criteria before going into your full investor pitch. Find out if an investor can provide the minimum capital you are looking for and if they can invest in your sector. Now, what I have noticed is a food company is going to a technology investor, a tech company is going to a food investor. They have not studied the website for the thesis. They don't know their ticket size. They're just reaching out. Essentially, I avoid cold calling, and this is what I emphasize in all my talks, that cold calling doesn't work in this industry. If you're unable to qualify your investors, hire investment bankers, but make sure that you have understood their investment thesis, you know something about the investor before you reach out to them. So what some of you keep doing is you run your business like as if raising money is the main objective and not running your business is the main objective. So your main objective should be running your business. Your raising money should be given to a different person who is well versed with the finance industry, and let them handle the show. So many of you are running your business as if raising money is only the main objective. I think focus is very important. I have seen people switching things after 2 months, 3 months, even after a 1 month's time, because there's lack of focus. So I think focus is very, very essential. So decide if you still want to sell metrics or sell a big vision. Now, depending on your business and the stage of your business, you may need to decide whether it's better to pitch the hype or strong metrics. Strong metrics that are eating up the competition means that you may not need to sell the dream because real metrics say that the business is working. Now, for instance, I have given examples of P-Safe, Escrow Pay, and IGP here. Develop investor pipeline and track interactions. Human memory is limited, especially when it comes to interacting with a lot of new people. One needs to maintain a record and track of people on a daily basis, especially in conferences, seminars. Do drop a mail saying a very casual hello and telling a bit about yourself and business. These are some of the networking skills that I'm talking about. Remember, most of the people don't do it, and you will have a relative edge and advantage. Also keep a track in order to refer to the last conversation you had with people, since then they might have moved to another fund or changed jobs. Now, I have seen founders continuously pinging somebody who's already left the job way 6 months back. Now, we as investment bankers, we know in and out of the investors industry who is leaving the job, what is happening, because we are regularly updated with that. So it's better if you keep your yourself updated whether the person is still in the fund, has he or she left the fund. Build a virtual data room for due diligence, which is extremely a crucial point nowadays. A data room is very, very important. Use proper communication protocols, and the elevator pitch preparation is a must, and one needs to practice it all the time. The elevator pitch is your ability to deliver your core offering, business model, and market opportunity in 30-second time frame. Now, if at the end of an elevator pitch the investor asks you, so what do you do exactly? Know what your pitch isn't effective and needs to rework. Hence, there are lots of people who are have expertise in this. You can use their expertise to understand how to make an elevator pitch, etc. Now, a company one-pager, a very useful document essentially used during pitch events. It is an extended version of the elevator pitch. Use this as a handout for the judges to learn about you. Jot down their questions while you are pitching. It is a document which is slightly longer and contains key ideas, opportunities, and target market details. Now, also many times you don't want to really send the entire pitch deck. So it's better to send a one-pager. It keeps your confidential information also intact, and in one page you can say everything that you want to. A corporate one-pager usually includes the stage of the company, revenue traction, market sector, amount raised till date, and the amount currently raising and existing investors if there are any. Your pitch deck should be maximum 15 to 18 slides. Founders, kindly don't make it 20 slides, 44 slides, 80 slides. Please keep it simple, short, in a layman's language. It will work. The pitch deck is a self-serving document for an investor to understand all key aspects of the business without the presence of the founder. A typical deck will touch upon areas like the problem, the solution, product, market size, competition, team, financial projections, and how much you're looking to raise, in addition to the data on the customer traction and user feedback can be added. Investors don't spend more than 90 seconds on a deck. Sometimes they don't have time to open pitch decks. So hence it is important to keep it short, simple, and to the point. Now, what are the key resources for fundraise? Make an Excel MIS and record the following information. I have seen lots of funds nowadays asking an Excel MIS, so I think it's important to have. LinkedIn Connects is very important, who can introduce you to the investor connects. Now, founders who have very, very large companies, they have not focused on keeping their website intact, keeping their LinkedIn profile enhanced. Sometimes they are doing a lot of good work, but they don't even have a LinkedIn profile. So you can also, LinkedIn helps you to connect to different investors. You can also ask for introductions if you have a common connect. And CEOs and founders of similar startups who can introduce you to their investors. Essentially, look up your network. Investment pitch events and trade conference contacts. Angel networks, accelerators, incubators focused on the sweet spot. Mark those VCs where you are directly having in target partners in these firms who have led investments in similar sectors before, because they have idea of the entire sector. So it's very, very essential. Can the shortlisted investor act as a lead investor or not? Now, yes, they can be they can be as a lead investor. So the answer here is yes. Investment size, please figure out the investment size and typical ticket size of the investor before you reach out to them. People you have interacted with in the firm. So the investor might ask you that whom did you interact with in my firm? You should be able to answer. It's very, very essential. Prior co-investors and investor relationships, very essential to have, and have inform everybody who were your prior co-investors, what kind of investor relationships you have, and does the investor also fit in your needs? It's very, very important. So just because it's an investor and they have an upper hand, that doesn't mean that they might fit into your system. So you have to actually understand, even if the investor is giving you a term sheet, whether that investor fits in your need, and have you checked the profile, have you checked everything about them. Now here is about sorry, I was clicking something and it went on the wrong thing. What do you do at each stage? So here are the stages. So when you're at survival stage, you need to monitor your burn rate, and your plan is your cash flow projection here. When you're at early revenue stage, you need to do your revenue forecasting, and you need to plan your marketing and sales funnel. When you're at an early growth stage, you need to look into your cost planning and plan a high level budget. And when you're at a growth stage, you need to do some decentralization and plan your operation plans. When you're at a scale stage, you need a real-time iteration and plan your dynamic planning. So it's very, very important that what to do at each stage. Many founders, they lose track as to what to do at each stage. Now, decoding the mind of investors. 7 ways VCs think completely different than you, and how you can win their trust. Now, an entrepreneur thinks about the potential and opportunity for the business first. They take a giant leap of faith that they can solve a problem they see, and it will result in a business model that works. This is the believer's mindset. Now, what does a venture capitalist do? A venture capitalist thinks about the biggest risks for their business. They are like detectives, searching for clues and staying neutral until they have built up enough data to form a strong point of view. So this is the difference. Now, an entrepreneur is naturally optimistic, sometimes to a fault, about the future because of their believer's mindset. A VC looks forward with a healthy dose of skepticism because they understand the costs, roadblocks, and time required likely will be higher than an entrepreneur anticipates. So, these are 7 ways that I'm going to discuss here. Edge versus outcome. Now, an entrepreneur's mind centers around their team, product, customer, growth, and maintaining a competitive edge in most of the days. A venture capitalist focuses on the speed, learning, progress, financials, and potential outcome in most of the days. This is the difference. A deep understanding versus a broad view. An entrepreneur has a deep and focused understanding of the industry vertical and the stage of their company, focusing on developing a detailed strategy to reach success. A venture capitalist has a broad view of various industries and stages of the company, focusing on the macro patterns and behaviors that lead to success. Deep emotion versus being grounded. An entrepreneur is all in on one business. They live and breathe this business daily, and it can mean a deeply emotional connection to what's happening in the business. A venture capitalist has a portfolio of companies they support, and they expect that only 1 to 2 of their investments will break out success. Because of this, a venture capitalist maintains a more surface level and less emotional connection to the business, which can sometimes bring a more grounded point of view at critical moments. Now, this is some of the things that I wrote here: grow fast or die slow. And valuation means essentially show the money. Like the investor always wants to see the money. So thank you for your patience. I would just stop sharing my screen and I'm open to questions now, but I will direct it through Divyansh.
Sure, thanks. Thanks a lot, Vandana, for the session. And I would request all the attendees that they can start putting in their questions in the Q&A section. So before we start, we have one question from Amit Veer. Should we hire an IB at the seed stage? It's difficult to get 100 connects when starting.
Yes, it is very, very important to have an investment banker on board right from the early stages, because they will help you build the right kind of pitch deck, the business plan, the financial model, your video pitch deck, your one-pagers. They will help arm you with FAQs of investors, sample term sheets, DD list, exit options, and they have essentially more than 100 investor connects. So it is important that you hire them, you focus on the bootstrapping, and they can help you with your fundraise. So essentially your fundraise part can be taken care of.
Akshay Jain asked that what is virtual data room?
So virtual data room is linked with a hyperlink where you put in all your data. Whenever it is clicked, with which email ID it is clicked, you will get a notification. With a virtual data room, all your data, which is your financial data, your valuations, your financial projection, goes into that data room. So if any investor wants to have a look at it, you can just share the hyperlink. That's the in trend nowadays.
Great. Ramakrishnan Raghuraman asked, it was very good sharing, but will be good to get some material, your points around how a VC think versus a founder. A bit more.
Yeah, sure. So essentially, you have to first thing, like I've always said, for founders need to have their things in order. Now, when I say things in order, means they must have a CFO on board, an advisor on board, an investment banker on board, having a pitch deck in order, a financial model, business plan in order. This is the second step. Then the third step is to reach out to the right kind of VCs. VCs are always looking. Now, what founders do is, because they are so emotionally connected with their business, they tend to hype up their valuation even when they are informed with the investment bankers. For instance, we had a founder whose valuation when we calculated was 70 CR. But he was, somebody in his team had calculated and given him 150 CR. So we had to give him a lot of reasoning as to why we are showing him this valuation and how can he get his investments with this valuation rather than that. So if you are just throwing up any valuation, it will never work. For investors, definitely they are looking for companies with lower valuation, so they will go with that. Founders are not getting investments because they are hyping up their valuation, and hence it is very, very essential to understand that you need to be grounded. Entrepreneurs, sometimes when I say grounded and being humble, I don't mean that one needs to be submissive, but one needs to be able to pivot, speak in such a way that the investors get attracted to your business and invest, and you can always ask them, look, how much do you prefer? And then we can always go back, decide with your investment bankers and advisor as to what you need to offer, rather than that time being aggressive, etc. So this is what one tip which I had for you. It's very important, and you can also read this book, The Intelligent Investor. Divyansh, don't mind, I want to show this. Very important for everybody, because this books, if you are doing any investments, will help you. If you are raising investments, will help you. So please read this book, The Intelligent Investor.
Great. Basically, this was our next question from Shiv Kumar. Do you suggest any book as well?
Yeah, many books.
So hope that answers it, Shiv Kumar.
Yeah, there are many books that I can suggest after the session, so you guys can have a look.
No worries. So Vikas Chandra asked that please inform about the due diligence process and what are critical things a founder can keep in mind while going for investments.
So the due diligence process takes about 2 weeks. Investment bankers usually have a list of due diligence documents that they will give it to you way beforehand. You need to compile those documents, keep it in a folder ready. If need be, take suggestions from your investment banker. The moment you receive your term sheet, please don't waste time compiling the documents. If it is already ready, hand it over to the fund so they can do the due diligence. It takes 2 weeks to do the due diligence, which contains your KYCs, essentially all your deep diving into your financials, whether the numbers that you have shown are real or no, whether the company is running up or no, whether the website is running, the LinkedIn profiles of all the founders. And what was the other question? Sorry, I forgot. One was on due diligence, the other was?
Just a second. Yes. What are the critical things a founder can keep in mind while going for investments?
Critical things, like I said, is not having your documents in order, not having a private limited company, not having 2 to 3 founders on board. These are some of the basics. If this is not sorted, having a website in order, all the LinkedIn profiles of the founders in order, showing up, if you have 50 employees on LinkedIn, it should show 50 employees. Very, very essential to keep these things in mind. And rest, whoever is your investment banker can guide you properly as to the entire processes.
Great. So, Ramdas asks, what is your take on focusing on building value versus valuation?
See, both go hand in hand. Our values are essentially also important. The valuation is also important. There has to be a balance of everything. If we are not authentic, if we are playing with our moral values, then at some point we will go for a toss. Similarly, if we are misquoting a valuation, when the KYC is done, when the DD is done, at some point the truth will come out. So it's better to be realistic, go slow, but get your things done in a proper manner.
Great. We have a question from Sai Dhiraj, and I think this is some question for many of the founders as well. How do we expose the idea at pre-seed or seed stage?
Firstly, you need to get the idea vetted by an advisor on board or a senior mentor, and create a proper business plan. Now, business plans gives you a lot of clarity about your business, yourself, and also about the kind of investments that you're going to ask for. If the idea is not doable, and if somebody points it out, maybe you should consider thinking about it, because sometimes all ideas don't work. So it's very, very important to get a business plan done. A one-pager, show it to somebody, get it vetted by a senior in the industry, and then take things forward.
Okay. And just a follow-up question there, what is a recommended level of dilution at the seed stage for a founder?
At a seed stage, it's 10 to 15%. Sometimes it goes 7 to 8%. We have seen in Shark Tank it is 2 to 3% and 1% as well, because that was small amounts that they were putting.
Great. Meera asks, how do you choose the right IB for your business, and how can tier 2 or 3 startups reach them?
There are a lot of, they are available on LinkedIn, but of course, you can look up platforms like these. They have the right kind of investment bankers. See their LinkedIn profile, maybe check their testimonials, check their website before you reach out to them. So I think that's the way you can reach out to them. I think LinkedIn, email, website is the best way to reach out to the investment bankers. There is always a Google rating also that follows along. So all these things you can check. Once you go to any profile, automatically the profile speaks about the particular investment banker, investor, or founder that you are reaching out to. So I think that will give you a lot of clarity in itself.
Great. Nakul asks, how can you protect your idea? Should we get an NDA signed before sharing each pitch deck?
I don't think, unless it's very, very like a patent technology, wherein you've already filed for patent, and then you're reaching out to the investor per se. I think in that case you can get an NDA signed, because still your patent has not come in. But every time you show up any idea, you don't need every time somebody to sign an NDA. Investment bankers sign NDA day in and day out. Investors do sign an NDA, but at a much later stage. If your idea is not doable and you're getting somebody to sign an NDA, it won't work, because anything can be copied very easily. You cannot hide your idea for too long as well.
Okay. So just a practical question here by Sai Dhiraj. A couple of us are working on an idea, but we are not sure if we should go ahead and build it and do market survey, everything, and then seek advice. Do any VCs come in at idea stage to offer advice? They trash the idea? Are these the possible scenarios or what?
very few companies get funded at idea stage. It is better to show your idea to an investment banker first, then reach out to a VC. And angels, some of the angels do fund at idea stage because they believe in you and what you're building. So again, it depends on what you're building and how attractive it is and what's the future of that idea. So all VCs don't crash idea stage. In fact, there are some VCs that they only look at idea stage, but also depends on what idea it is.
Great. Again, Nilima also have some practical question. Ours is a B2B AI product used for testing AI products. It's a new concept and we see great market value. How do you think I can evaluate it?
Have you made a business plan? You can show it to me offline. We can take this offline and we can help you with whatever help you need with. Divyansh can share my mail ID as well, or I could be reached out on LinkedIn. We'll have to check everything before we advise you anything.
And just for the information, under Founders Genie, Vandana is also there as a mentor. So in case you wish to reach out to our one-on-one on Founders Genie platform, that also can be done. Great. So Vandana, Abhijit Parmar asks, for seed stage, we often see greater dilution apart from defining the basics. How do we justify an 8-figure company valuation there?
See, again, it all depends from founder to founder and investor to investor. Definitely, at an angel round, you have to dilute between 20 to 25%. This is the standard thing. Some people get desperate and they want to dilute 50%. At a VC stage, it is only 10 to 15%. Sometimes it's even 7 to 8%. These are the standard rates. So if you're aware of the standard rates, I think you can always sit across table, negotiate, and you might not have to dilute so much unless you are in a state of desperation.
Great. Yes, we have one more question right now from Atul. How to determine equity percentage to be offered as part of the funding ask? Is there any minimum threshold that is 25 to 40% along with different set of rights such as ROFR, etc.?
So like I mentioned, the thumb rule is for angel investors, it's 20 to 25%, and for VCs, it's 10 to 15%. Sometimes it goes between 7 to, so these are the thumb rules basically. If you know these thumb rules, then I think you can also, when we do your financial modeling and valuation, we can actually derive from there as to how much should be your dilution, how much should be your ask, etc. For that, we need to work on that if you want a perfect figure.
Okay. One more, a good one. How do you see Indian startup ecosystem compared to Singapore and Indonesia?
I think Indian startup ecosystem is really doing well. You have seen there are so many unicorns that have come up. We have seen so many IPOs that have happened. Women entrepreneurs are leading the show like Nykaa, etc. So I think the only factor is that more holding companies get created in Singapore because of the tax issues which India doesn't allow. Other than that, I think India is doing pretty well, and we are I think doing better than Singapore and other countries in terms of the startup ecosystem. There's a lot of capital, a lot of startups get funded every day. I don't see any problem in India at all.
Abhijit Parmar asks, VCs generally stay away from manufacturing startups in climate action space that are not using IT solutions. Any thoughts on that?
That is also not true. Maybe you are reaching out to the wrong VC. There are VCs that actually focus on these sectors. There are VCs that don't focus on these sectors. So if you are reaching out to the wrong VC, definitely you will come across rejections, but if you're reaching out to the right VCs, and there are some venture debt funds as well, you will get the right kind of investments. So there are, like I said, that sometimes founders are not reading the thesis of the VCs, and then they feel that maybe this is not happening. So I think maybe you're not reading their thesis before reaching out to them or asking them around. Many manufacturing companies are getting funded as well.
Okay. I think we have another question from Nilima, and it usually comes to us also at times. I think this would be a right platform to address this. She says that we have bootstrapped and now looking out for funding for nearly 10 CR. Should we name it as angel or VC funding?
No, don't have to name it as anything. But essentially, angels don't do 10 CR. Angels only do up to 2 to 3 CR. 10 CR would be done by a VC only. So, I think you need to reach out to a proper VC who will give you this amount.
And I guess the valuation also will depend that how much funding they could
Yeah.
raise, right?
Yes. Also, if you are, too hyping up your valuations, you have not checked your documents, or your valuation is not done by a professional. So, I would like to slightly highlight this point. Many of us do our valuations by CAs. And CAs want to make the founders happy and take some money for that, and then they don't give, they just give whatever the founder wants. So that's the incorrect way. Get your valuation done by a proper investment banking firm who does this at a regular basis, who have 20 years of experience at least, or 15 years, and then actually reflect that whether what you're proposing is authentic or not.
Okay. And will that also be necessary that for a VC to see that if any early age company or angel fund company has previously invested in the startup or not, or
Yes.
anyone can directly reach to a VC as well?
It is important that if it is self-funded also before, how much of the founder's own money is in the, how much, the skin is in the game. So, that you need to see as well. Whether it was funded by an angel, whether it was a relative, a family person, a friend, who was the actual person who did it. So I think if you already get funded once, then the second, third, fourth round, fifth round is very, very easy. It's just the first one that you need to click in the right manner with the right set of people. So I think that's what is important. Also, VCs do check LinkedIn profiles, websites. They are in the market. So we were proposing a food deal where they already knew about the founder's background, and they even wrote to us what the founder is, etc. So kindly keep your things intact. Even if you're a founder, make sure that you are doing the right things in the right manner. Otherwise, VCs already have a lot of information from the market.
Great. So we have another question from Atul Bula. How does the interest rate scenario affect the valuation at exit for startups looking for IPO? Do you feel that a lower interest rate scenario may lead to exaggerated IPO exit pricing?
Sometimes it can, but again, it depends. We have to study the entire thing. It depends from company to company. So, I think it has to be normalized, how it is presented, what it is done, what rate of, what rate is going where. For that, I'll have to check everything about the company again.
No worries. So, Mohammad Bakar asks, not sure which industry specific is he looking to ask for. What is the preferred instrument of funding we should look at? Safe, convertible notes, etc.
So, VCs do help with convertible notes. They help with equity fundraise as well. There are venture debt funds also that help you with the fundraise. So again, it depends what industry you are, whether you want to go for a bank funding, which is essentially a debt you can take from an NBFC or a bank, which takes 21 days. But if you want to look for more classy things, then maybe you should go for an equity fundraise, which is better to go with in any time.
Okay. I think we can take this last one from Naveen. Besides the sales numbers in an early revenue stage startup, how does the social equity taken into account for valuation? So he has also given an example, like here they are in agriculture segment and have a strong and commercially exclusive farmer relationship. Would that be a part of valuation, though exclusive commercial relationship is not part of our business plan?
See, valuation is essentially about numbers. So what are your numbers? What is your current turnover now? How is it that you have come to this conclusion about valuation? Relationships is totally different. What you're talking about. But when you're calculating your valuation, I think whether you have firstly done it in the correct manner or not. And then what is it the valuation that you're proposing, and why do you always, all the founders want to go directly to the valuation? Why don't you just go stepwise? Like for instance, get the interest first from the investors. Valuation is the last part. Get your term sheet done, get everything done at the point of your term sheet discussions. That is the time when you should discuss your valuations. If before only you are doing and there's no level of interest in your business from any investor, then essentially you're wasting your time. So don't make valuation, like I've said in my PPT also, the end, like the end thing. It has to be, don't make the valuation the main purpose like that. First go stepwise. It's like when we buy chocolates, they are wrapped in a very nice way. We get attracted to it. We are buying chocolates, children and elderly people as well. So when we are selling our company to investors, we have to wrap it up in a story. Now, how is it that you've created your story, your pitch deck, your business plan, your vision, which speaks a lot about you? The valuation is at a later stage when you're having a third or fourth meeting with the investor essentially.
So I think we have last one or two questions and then we can wrap up. Mohammed wanted to ask that what is the ideal time frame it takes for startups to get an investment deal from investors?
2 months takes for term sheet to come out, 2 weeks takes for DD, and 2 weeks takes for fund hitting your account. Essentially, it takes 3 months. In rare case scenario, it takes 4 months.
Great. So last, just Harshita asked that any idea how to reach right VC? Is there any secret way we can reach the right kind of VC, or how should we exactly do it, Vandana? This is something which should be on many people's mind.
See, firstly, say for instance, you are reaching out to VCA. Have you checked their website? Have you checked their thesis? Have you checked their LinkedIn profiles? Does it match with your sector? If you are a food company, please go to a food VC. Don't go to a tech VC. So all this information the investment bankers have, because they are in and out of this market. Sometimes suddenly the thesis changes, of the fund, so which you might not be aware of. So hence it is very, very important that you make a conscious move around this. Otherwise your deal will get killed. Now investment bankers are starred in the mail of the investors. Their deal is, whatever deal goes to the investment bankers first taken into consideration. Your deal might go into the spam folder because you're doing cold calling. So hence it is important that you're consciously taking your steps, unless you have a very strong relationship over wining and dining with these investors.
Great. Thanks a lot, Vandana, for your time for this session, and we would look forward to see you in many upcoming sessions as well, with great set of knowledge. And for the attendees, members, I would just share our Founders Genie QR code in case anyone wants to scan it and join Founders Genie as a complimentary member for a small period of time, so they can do that. So with that, thanks a lot, Vandana, for your time.
Thank you so much for calling me here. Hope I could share some insights. For everybody out here, please feel free to connect with me via my LinkedIn handle or my website, or via Divyansh or via Founders Genie. And once again, great audience. Thank you for having me here and great questions.
Thank you, Vandana, for your
Bye.